Hey, folks. It is Wednesday, an unusual Wednesday webcast. I'm Dave Burrows. I'm CIO and CEO here at Barometer Capital Management. I've been on the fly this week, out doing meetings in Western Canada, and so a little bit of a scramble to get the deck put together for today. But I mean, certainly there's lots going on. We are right in the middle of earnings. Earnings in general have been pretty good. Earnings growth coming in around 11%. Revenue coming in about 3% higher than what has been expected. I haven't seen what's happened since the close. We're into sort of the big tech earnings now, so it's going to be an important few days. Increasingly, the U.S. market looks more and more like the AI market. It has become very, very polarized. Certainly, there's some great leadership, and there's a lot of have-nots. So lots to talk about there. And with that, maybe I'll just jump in and we'll start off the hop. We continue to be in quite a positive structural bull market in the U.S. If we look at the near term, the S&P is up 2.9% as of about 3:45 this afternoon. 2.9% in the month of October. We're coming into the end of October. We are in a seasonally stronger period, and the headline indices, look pretty good. Under the surface, there is some question marks, and I'm going to talk a little bit about that today. There is money in motion. We are seeing some alternatives, and so I think it's important to take a look. Certainly, valuations, continue to be quite high in the U.S., whether it's price to book or PE or just the sheer exposure to U.S. stocks is pretty high. Equity risk premium is low, meaning the cash flow on the S&P 500 is less than the yield on a treasury bond. So that's the premium you're getting paid to take risk. So many would say, well, if you're not being paid a premium to own equities, that should be a question. Clearly, there's been capital growth and multiples have been expanding. But the overall multiple of the market continues to be quite high relative to some pretty important points in the past. So we want to keep all that in mind. And the outperformance has been strong, although outperformance of U.S. stocks versus the rest of the world has been somewhat reduced recently. And that's something that we're keeping a really close eye on because the developed world, ex-US, continues just to power ahead. These are monthly bars. And you can see now 1, 2, 3, 4, 5, 6, 7 months having made the first new high since 2008. We probably are not the only ones recognizing this. But this is something that's been coming for a while. And when you break out of a range that you've been in for a decade or 15 or 17 years, you really have to take note of it. All of the stakeholders are now happy. Anybody who wanted to sell, hoping to get their money back, has had their opportunity. And now we're at new highs and really everybody is making money. This started quite a while ago, and this is kind of what got our attention to build our international fund. India broke out in 2021 and has had a couple of legs higher since then. The TSX, which tends to work a lot like the international markets, did the same thing in the beginning of 2021. Taiwan broke out midway through 2020, and again is trading big, virtually at highs. Australia broke out about 6 months later than the TSX of this long slumber that it had been in. And we've been pointing out the Eurozone now for the last 8 months has been marching higher. Japan continues, now up 28% since it's made a new high after 33 years of no progress. Feels like a lot, but sure isn't relative to the last bull market. So something we need to keep in mind. I've been doing a lot of reading recently about the shareholder rights bill that was passed in Japan and what that meant for companies being incented to restructure if their shares were trading below book value. So lots of change taking place there. Similarly, in South Korea, some reorganizations going on there and some restructurings and shareholder rights, which are making a difference. We're breaking into new highs again this month. So you can see around the world, this just continues. Shanghai, 3 months, having made new highs for the first time in 10 years. Peru has been quite strong. And this is as of today, the EEM ETF, which is the emerging market. So different than developed markets. But the developed market ETF is now just on the verge of taking out highs going back to 2007. So this international stock move, or the broadening of participation in international markets, is becoming increasingly more persistent. And that's after very good thrust in momentum, which has historically happened early stages in a new bull market. So we're watching this relationship, emerging markets relative to developed markets, but frankly, both are doing well. Now, valuations continue to be, a lot higher in the US than around the world. So there is incentive if you're an international investor. After many years, you have an opportunity to invest in your own local market, your own currency. And we know that currencies have been doing a little better as well. So the rate of change for all world ex-US equities, so everything except the US, really is picking up some steam. And the relative price performance, outperformance, continues to stand out. So we're getting some great performance out of some stocks in the US, but we're getting some great performance in stocks outside the US in very different sectors, which is great because frankly, we all need diversification. I'm not sure we all want to be invested 100%, in the AI revolution, especially if there's some outperformance to be had at lower valuations. TSX continues to climb on a relative basis versus the S&P as well. And so what that means for us is we just have less exposure to US stocks. We think that Canadian market's less crowded. There's some have and have nots for sure. But we've been able to find some great positions. Celestic has been great over the last few weeks. We just added some Bombardier. But really, I think in a typical equity portfolio today, US stocks would make up less than 35%, and probably closer to 28 or 29. So this is a shift that's taking place, and we're trying to stay on top of it. Now, in the bond market, not much different. Yields continue to be sticky in the long end. We talked a lot about the fact that we should be watching for a pickup in inflation or a second wave. And we've highlighted over the last couple of weeks that a lot of the components in CPI are rising faster than the Fed's 2% annualized target. The percent of components above 2% is rising. And if we do sort of the actual CPI versus the CPI 2% inflation targeted trend, we are way above trend. CPI is annualized at 4% since January 2020 when COVID began. And the chances of inflation getting back to the 2% are increasingly more narrow. I'm doing some reading on that this week, and just so many components. Now, the one component that's been helpful is services, which is housing. And that makes sense because in rising interest rates, it's hard for housing prices to go higher. Certainly, last time interest rates went higher from 1951 to 1981, house prices fell in inflation-adjusted terms for 30 years. Versus what we've seen over the last 40 years, which was, of course, rising house prices, inflation-adjusted. And we have a lot of mortgages coming up for renewal in Canada. 2026 and 27 are big years for mortgage renewals. The number of new listings continues to build. And the number of people looking to purchase looks like it is declining. We've been focused on dividend growth in this environment in the core of the portfolios. And as of this week, again, dividend growth as a strategy is making a new relative high versus buying high dividend paying stocks, which act more like fixed income. Commodities continue to march their way higher. Certainly, it has been led by gold, but you can see gold backed off a little bit. In fact, today we were below $4,000. Want to make sure that I make this clear. We said a week ago we were reducing and moving away from gold equities and gold itself. It's a tactical move. And it's based on the fact that gold became very stretched above the long-term moving average. In the last bull market, when we got this stretched above the long-term moving average, you had a correction that lasted about 4 months. And so to put a point on it, it retraced in the 2000s 61% of the gain made since gold made a new high, which would represent a move down to around $3,000 an ounce. So whether we get a 50% retracement or a 61% retracement, this was what you could have expected. And this was not meaning that the bull market was over. It just meant things needed a rest, got a little bit overcooked. But they corrected for 1, 2, 3, 4, 5 months before it started to work its way higher. 2 sharp months down, a bounce, a retest of the low, and then onward and upward. The correction was about 123 days. So this happened after gold had run up for 577 days, and gold moved up about 580 days before we got the weekly reversal, where we went to a new high and it closed below the low from the week before. Now we think that gold could be pretty resilient because central banks are certainly continuing to buy. They are the major buyer. And private investors sort of have a lower weight than one would expect given the percentage point move. But we are seeing a pickup in other commodities, and this is important. Copper's had a great move. In fact, moved higher today by a couple of percent. And uranium's had a great move. Yesterday, our chemical position, I think, was up about 22 or 23% on some of the announcements of additional nuclear power plants to be built in the US. So commodities continue to show us that inflation is the market's key concern, because commodities relative to bonds continue to outperform, and commodities relative to equal weight S&P continues to perform. Now on the currency front, US dollar has bounced a little bit off the lows versus the basket of world currencies, but you can see it's been a steady, lower low, lower high, lower low, lower high, lower low, lower high. That's a downtrend. And my guess is that we will likely resolve lower, which means euros go higher, Canadian dollars go higher, pound sterling goes higher, Japanese yen goes higher, and the US dollar weakens for a while. No change in this. So if we're international investors and our local markets are all doing well and our currencies are appreciating, it probably is not a reach to think that international investors may look to bring some money home and reverse some capital flows that have been in place for a long time. In 2000, when the S&P rolled over, international and emerging markets both rallied for the next 10 years, and Canadian stock market did as well. Now, foreign investors now make up, own 18% of U.S. equities, which is the highest ever. So the marginal dollar of demand possibly could reverse flows. We're watching that closely. But clearly this move in global equities is very interesting. And, sovereign bonds outside the U.S. are outperforming U.S. sovereign bonds. So something to keep in mind. Now, from a breadth perspective, and this is, I think, the most important thing for us to be watching to manage risk. In the US stock market, the percent of stocks in uptrends has been falling, meaning the market is narrowing. And I track that by running point and figure price charts on every US equity, and we break the world up into buckets like the NYSE and the NASDAQ and the Russell 2000 and the entire composite. That is in stark contrast to what's happening in international stocks and the Canadian stocks. Breadth is expanding outside the US, it's narrowing in the US. So to put a point on it, in July of this year, 74% of companies in the S&P 500 were in clearly defined uptrends based on point and figure charts. Today, that number's below 50. So it means 50% of stocks are doing well, but 50% are not. I thought these were really interesting statistics from the last couple of days. So this was a statistic from yesterday. Yesterday, the number of stocks that were up versus the number of stocks that were down. was really quite something. It was the worst day since 1990 for breadth. So 300 stocks were down. Total of 400 stocks down, 100 stocks up in the S&P. And if you look at what happened to the market cap weighted or size weighted, our S&P 500 relative to the equally weighted S&P 500, the average stock had a very different day than the index. And part of that would be NVIDIA up 5% yesterday. But, by lots of different measures, breadth is not good. There's an old rule, the Dow transports rule, where you like to see if the industrials are making new highs, to see the transports also making new highs. Transports are a great indicator of what's happening in the economy. And this is the transports index, which hasn't made a new high since December of 2024. So that's an obvious concern. So keep in mind. We talked before about gold outperforming the QQQ, which it continues to do. Now, in the early 2000s, when commodities and international stocks started to outperform, the top performing assets for the year in 2003, 4, 5, and 6, and 7 were developed market equities outside the US, emerging market equities outside the US, commodities, and REITs. Now, REITs are having a hard time, so they are not in the mix here. But in 2025, gold's the best performing asset, emerging markets second, developed markets third, S&P fourth. When this starts, it can go on for a while, but that is continuing and continue to take this temperature. The Barometer Global Fund continues to chug along. It's now 57% over the last 2 years. The All World ex-US Index up 46, and the equally weighted S&P up 31. So we're sort of continuing to chug along, and it's diversified across a whole bunch of different sectors. But importantly, geographically, it looks quite different than the MSCI All World. It's about 17% China, 17% Japan, 14% Latin America. Europe's only 10%. Europe makes up about 60% of the All World Index ex-US. And from a security perspective, about 80 securities, half of them are value oriented, and that gets rebalanced every quarter over 12 quarters. And the other half is strong relative strength performance and momentum stocks. And they have an acceleration phase, a steady state, and a deceleration phase. So we are rebalancing that once a quarter, balancing in newly accelerating companies and balancing in decelerating companies. So that continues to kind of come along. So let's talk sector leadership for a minute. I'm not going to go through everything today, but there's some things that stand out to me. Clearly, the NASDAQ continues to chug along. We are really at the very top end of the channel, and we are just reporting earnings. So the next couple of days, we'll see how the market reacts to the earnings. Really important companies are reporting. The semis have just chugged along. Look at the relative strength, making new highs and absolute new highs. NVIDIA, an obvious important stock, biggest company in the index, coming up on pushing $5 trillion in market cap in a great 2 days, 3 days. So their earnings are to come. Microsoft as well. Materials have continued to perform really, really well. Cameco, one of our biggest positions, up 23% yesterday. It would be in our top 10 positions. On financials, financials have been a key group for us now for the last 3 years. And it is a group that tends to do well when there's higher than expected inflation because asset prices are going up, and that's the collateral that they hold. And the spread between short-term rates and long-term rates has been significant, so net interest margins have been growing. But I will note that while they have been chopping sideways for the last 7 or 8 months in the US, in Europe, they are marching higher. So JP Morgan continues to perform well. Santander better. Santander reported last night they beat on all metrics. Their fee revenue from management fees and investment fees are growing nicely. Their consumer business is growing nicely. And it continues to have a much, much lower PE than some of the large US banks. The Canadian banks continue to perform really well, the strength continuing to rise. The things that we're watching that we're a little concerned about and we're keeping an eye on, first of all, the XLF as a whole, which is the broadly diversified financials ETF in the US. It includes the insurance companies, the banks, the regional banks, and so on. Relative strength is waning. Now, that can be a little bit misleading because there are specific parts of the index that are waning. Insurance. If you'll remember 6, 8 months ago, insurance was a pretty big weight for us. And I think Fairfax was the last one that we sold not that long ago. We sold half of it 3, 4 months ago. We sold the other half maybe a month ago. The insurance sector really is starting to underperform. It's been unable to make a new high since the end of December last year. And look at the relative strength, it's really caving. So that's something we're keeping an eye on. Regional banks. So these are the local banks in the US that have a lot of commercial loan exposure, a lot of real estate exposure, domestically focused. Relative strength is really waning and now trading below the 200-day moving average. That's a concern. That perhaps is pointing to some of the risks in credit. Digital payments, companies like Amex, Visa, MasterCard, PayPal, Fiserv was down big today. And the iPay ETF broke all the most recent lows, and you can see relative strength really falling off. So we're watching this group closely. One of the concerns in the market is how is private credit behaving? There's been a big boom in investment in private credit. When you have a boom like that, investments don't get made perfectly. We'll see what happens there. The second group that we're a little concerned about is the consumer. And so when we look at different consumer-based groups like the home builders, some weakness here. This is the high in the home builders was October of 24 at 129. So you got 100, so down 30%. Relative strength making a new low today. And very close to breaking the 200-day moving average, which has been declining. So really anything around real estate and housing. This is the ETF, VanEck Mortgage REITs ETF, so holding mortgages. Relative strength very weak, and all of the moving average moving lower. In disclosure, we're short the home builders, we're short the mortgage REIT, we're short real estate as a whole. This is relative strength for the Dow Jones Spider REITs ETF, now below the 200-day moving average. Retail. So broadly diversified retail in the US. Again, relative strength, new low versus the market. And consumer staples really had a tough day today, and they've been underperforming for a long time. The consumer staples week. So the consumer is something that we're a bit concerned about. And interestingly enough, the most defensive parts of the market continue to be really weak. This is the S&P 500 low vol ETF, SPLV. So high dividend paying, but low economic sensitivity, particularly weak. So there are some things that we need to watch. Now, industrials continue to perform well. This is equally weighted industrials versus the S&P, in particular machinery. Fitting equipment is Caterpillar in Canada, the UK, and South America. Premise here has been that a mining cycle is going to be creating a bunch of demand for Caterpillar equipment. So Finning has been a really great stock recently for us, and Caterpillar reported their earnings today, and their orders were up just over 25% year over year. Inventory on their lots are down. They are seeing very strong demand. And they actually have a really interesting business that people haven't talked much about, and that's their generators business, their gas turbine generators, which are being used in data centers. And we think that maybe that can really ramp up quickly, but certainly Caterpillar is up 12% today. So this really is a market of haves and have-nots. And we think we've got some great companies in the US, we've got some great companies in Canada, but we do think it makes sense to continue to diversify beyond North America. In the energy space, very specifically, certain stocks performing better. Um, the large caps like CNQ and Suncor, a little better over the last couple of weeks despite very weak energy prices. Tamarack Valley reported their earnings today, came in well ahead of estimates. They're getting really great results out of the water flood technology they're using in the Clearwater play. So their production is strong and their cash flow is strong. And we think we're going to see some pretty good dividend increases here. So it's a bit of a whirlwind today. I think a lot is going to depend over the next couple of weeks on tech earnings and whether that leadership can continue. It looks like the spending is going to be high, the capital spending is going to be high, but some small tactical moves. We continue to reduce our financials weight. This was as high as 28% early in the year. It's 18 today. Industrials has continued to grow, now at 18.5%, and there clearly is money being spent on reshoring and on power generation. Materials reflects the fact that we took our gold weight down. This was as high as 18%, and we have increased our copper weight. Technology is about the same at 11%. We are carrying a 12% cash weight based on the fact that breadth is sloppy in the US market. And we think it's not a terrible thing to have a little bit of flexibility just in case there's some disappointments. On the more defensives, really, as you can see from those charts, there's no reason you to be topping up bonds. There's no reason to be topping up consumer staples or real estate. Consumer discretionary, we're being very careful on, and healthcare, continues to be a little bit sloppy. So the Fed cut rates today, 25 basis points. He sort of let it slip that there might be debate as to whether there would be further rate cuts. Market didn't like that very much. They plan to freeze the Fed's balance sheet, so they will stop quantitative tightening. And he did recognize the fact that the consumer economy is split. The wealthy are spending money, and of course, those that don't own assets that are appreciating are having a hard time with the rising cost of living. So I think that supports our view that dividend growers are probably a good cohort of securities to continue to focus on. And that's really sort of where we sit. Maybe what we can do is take some questions. Peter, Barometer Capital Investment Strategy, one of the best companies in the sector, well rewarded in Cameco, in the uranium sector, at least. That's very, very kind of you, Peter. Thanks so much. It looks like the nuclear sector is going to continue to perform well. PWX Technologies continues to chug along, and certainly Cameco has been strong. And it's spreading into the other uranium producers. If it seems there's a glut of consolidators or roll-up companies going on, First Service, Constellation, Fairfax, etc., all appearing very challenged right now. Why do you think this is? And are they looking attractive? It's an interesting question. I'm not sure that there's a thread there, but I would say in general that private credit related companies are performing very poorly in the market, and private credit has been used to finance some of the roll-ups. The cost of credit is going higher. We are short one public private credit ETF, and we are also short a private equity ETF. Our sense is that the higher cost of capital is going to make it hard for companies that consume capital, and the roll-up companies definitely do that. Something to think about. Next question. I've done well with thinning. When do you decide to trim? That's a great question. So the history is that the equipment company, the company selling picks and shovels, tend to start to perform about a year after the beginning of a precious metals or commodity bull market. And that sort of happened on cue. If you look at the scope of all of the money that's being raised in public markets now for earlier stage um, materials companies, there is certainly going to be money to be invested in equipment. So these should be less volatile than the commodity companies themselves. They build a very big order backlog, and it takes a long time to deliver. I think we're early stages, and so I think we're early stages on the drillers like Major Drilling and the companies like Finning and Caterpillar. There's obviously other levers that are involved other than just commodities, but they're at the margin a big contributor. I would plan to be there for a while. Um, Anonymous, can you tell us why we took down financials? Well, just to recap on financials, there's a bunch of different subsectors within financials. We did have quite a significant weight in insurance companies over the last couple of years, in particular the property and casualty companies. We owned Progressive and we owned Fairfax and we owned Intact. But given that some of the weaker securities in the sector started to back off, that gives you a tell that maybe there's a little bit less buying interest. Um, and So we stepped aside and took our profits. They started to relatively perform worse than they had been, and they were extended. So that's one reason. We did have a little bit of regional bank exposure up to about 6 months ago, and we took that off because some of the questions were on credit. Our Canadian banks continue to perform well. Power Corp, which is a financial holding company, but performing really well, a great dividend grower, continues to be an important holding. JP Morgan and Santander aren't going anywhere. So we do have exposure, but we've just taken down some, given the weaker sector. Uh, and any comments as to volatility in TFI? I have to be honest, I haven't looked at TFI closely recently. I'll have to take a look and maybe comment on it next week. And Thomson Reuters does it look interesting given it hasn't been performing recently? Look, I think that we are at the point in a market where if you have securities that are not participating, you have to consider trimming them, especially if you're in the US market. If you're in the US market and your companies are relatively weaker than the S&P, given the fact that breadth has been narrowing, what that means is one by one, stocks are getting shot. And the strongest are continuing on, and the weaklings are starting to underperform. So if you're holding an underperforming stock and breadth is narrowing, you are at risk of being the next victim. So we would be really, really careful about high grading our portfolios right now to make absolutely sure that holdings that we have, continue to perform. And we are being, more critical of our existing positions. If fundamentally they're fine, but the sector is weakening and holding is relatively weakening versus the market, we see that as an opportunity either to upgrade into an international security, or have a little bit more flexibility on the sidelines. I think that's it. Any thoughts on Constellation after the big dip? My experience is when a growth stock has outperformed and beaten expectation over and over and over and over again over a period of time and eventually misses, it is likely to miss for a long time. Companies pull every dollar of reserves out of their back pocket to make the number. And if they miss it, they have probably stretched their financials at that point. And when you have a lot of people who may be bought later on who are underwater, you've got a lot of built-in sellers. So I would just stay away from something that has broken way, but technically. Okay, I know it was a little hodgepodge today. I apologize for that. I was scrambling a little bit to get to everything put together, but I think that there's some important points to take away. I think that the weaker bread than the U.S. market is something worth watching. I think this very early stage move to international equities is an important structural change. And you know the materials. As you can see here, a question came up still about copper. You know, as I mentioned, copper looks like it's accelerating. The history is gold goes first, base metals go second, and energy goes third. Gold certainly has been rallying and now maybe correcting. There's money rotating, I think, into some of the copper producers, and we're watching the energy sector very closely for signs that it could get going. And the longer life asset companies in energy are certainly performing better. So I think that's a decent tell. Thanks everybody for joining in this week, folks. I'll be back on Tuesday next week. I have a little bit more time to prepare, and hopefully this is useful. We'll have more tech information, tech earnings reports between now and then, and we'll update at that point. Everyone have a great day.